So what I'm going to do is to present a very important tool for general equilibrium modeling. This is an accounting tool which is called the social accounting matrix. So what I'm going to do in this video is to present the basic principles. And for more details, because I do not want to give all details, because it would be very lengthy, you have two articles which are uploaded on the platform, one in English, one in French. And of course, you can also upload some articles from internet, because there are many articles about social accounting matrix. So I will start with something very simple in this video. Why? This is because of course you've got these articles to have supplementary information about social accounting matrix. But I'm going to give you in this video only the basic principle of construction, but also I will illustrate the constructions of a social accounting matrix with reference to the previous general equilibrium model, which I exposed in the previous video. You remember this economy which was described in this general equilibrium model. It was a very simple one with only one agent, one good, without government, without relations with the rest of the world, without savings, without investment. So it implies that the illustrations that I'm going to do in this video is very simple, with only a few data within the social accounting matrix. And what I'm going to do in the next videos, when I will complexify the general equilibrium model, well, I will introduce saving, investment, state, relations with the rest of the world, and more than one good. I will, of course, illustrate how the social accounting matrix is modified by the introductions of these new elements. So, what is a social accounting matrix? It is a comprehensive, flexible, and disaggregated framework. So, what I'm going to give you is the definition by round, which is the article which is uploaded on the platform. So this definition starts with this: a comprehensive, flexible, and disaggregated framework. So it means that it deserves some comments, because in fact it is comprehensive in the sense that, well, you've got production activity, consumption activity, all the different types of consumption, final, intermediate, consumptions of capital. It is flexible and disaggregated, meaning that in fact you can push the disaggregations very far, because you can of course have only one representative household, but you may have also a social accounting matrix with many households representing different categories of the population. But also you may have in each sector only one activity, or you may have different activities. You may have also one productive factor, or two, capital and labor, or three, or four, or five, for example, productive factors. So it means that it's flexible, and you can disaggregate social accounting matrix very far. So a social accounting matrix is a comprehensive, flexible, and disaggregated framework that elaborates and articulates the generations of income by activities of production and the distribution and redistributions of income between social and institutional groups. So it is the complete definition provided by Round in 2003. And so the second part of this definition means that we do not have only the generations of income by activities of production, we also have the distribution of this income. So from the production activity to the productive factors, then from the productive factors to households or enterprises. And you have the redistributions of income, that is to say, when you have income in the hands of, for example, households, you have, in fact, taxes paid by households to the government, and you have redistributions of this income by the states to other social and institutional groups. So I would like to insist on the fact that the social accounting matrix is something very complicated because, in fact, the objective is very ambitious because it concerns all these operations within an economy during 1 year, and it is consistent because, in fact, you will see that it is a balanced presentations and consistent presentations of generations of income and distributions and redistributions operation. So social accounting matrix is at the basis of a computable general equilibrium model. So you have to keep in mind that in fact the linkage between the social accounting matrix and the general equilibrium model is very strong. It reflects exactly the same reality, economic reality. And in particular, social accounting matrix reflects various interdependencies existing in a socio-economic system in the same way as a general equilibrium model reflects these interdependencies. You remember that you've got this economic interdependence in the general equilibrium models. It's exactly the same thing in social accounting matrix. For example, in this type of matrix, you've got production activity that generates income, which is distributed to households, and households use this income to buy some goods to, in fact, enterprises that have organized this production activity. So you've got exactly the same kind of interdependence. And second point is the fact that the social accounting matrix records not only economic transactions like productions, consumptions, but also transfer of income between various agents and institutions of an economy. So you've got production, final consumption, intermediate consumption, and so on, exports, imports, but you've got also transfers of income between, for example, households and governments, between enterprises and governments, between households and enterprises, and so on. So I remind you that I have uploaded 2 papers on the platforms to help you to deepen your understanding of social accounting matrix. So there is one paper in English, which is the paper from Round in 2003, and the one from Ismaël Fofana, which is in French, from 2007. And I would like to take this opportunity to tell you that in fact there are different ways social accounting matrix is presented in the literature. But of course it reflects exactly the same economic reality. I would like to give you other informations about social accounting matrix. First, the basic principles. So, in fact, very often social accounting matrix is related to an economy during 1 year, that is to say, one country during 1 year. So, for example, we will give you the social accounting matrix of Senegal for 2014. But of course, you can construct a social accounting matrix for a different entity. So, for example, a region of the world, like Western Africa, Southern Africa, Eastern Africa, Central Africa. But you can also construct a social accounting matrix for a smaller entity, like, for example, a province or a village. You've got in the literature social accounting matrix and computable general equilibrium model for a village. And the period of time is 1 year, very often. And of course, you can imagine something different, social accounting matrix for a quarter or for a period of 3 years or 5 years. Second point is the fact that you've got a square matrix. So it means that in a social accounting matrix, you've got as many rows as you've got columns. I will illustrate this point very soon. And finally, you've got a balance between totals of each row and each column. So, for example, the first row, the total is equal to the total of the first column. Same thing for the second row and second column, and so on. Okay, so these are the main principles. I will illustrate a social accounting matrix very soon right now, but I would like to say that the source of information is first National Statistical Institutes, which are in fact the main source of information, in particular because you need a table, input-output table for the design of a social accounting matrix. You've got also information from central banks, and you may have also some information collected by international institutions. And so all this information allows you to create a social accounting matrix. And of course, it implies some problem because, in fact, the existence of various sources of information, but also the fact that for an economy during 1 year, all the economic transaction, all the transfers of income are not measured with an absolute precision. So it means that you've got some imbalances when you start to construct a social accounting matrix. And you've got some balancing techniques which are available that allow you to obtain a social accounting matrix. And this is something that I will present in the second curriculum, but you've got some ideas of balancing techniques in, for example, the articles that I have uploaded on the platform. So here is a social accounting matrix with design, which is from Payot and Thorbecke in 1976, and you will read exactly the same design in Round in 2003. So this is my preferred design of social accounting matrix. I find that it is very clear and very easy to understand what happens with this way of presenting a social accounting matrix. So you've got a simplified presentation, slightly simplified because in fact you've got this title of rows on the left. So for example, you've got factors of production, institution, households, and so on. And you should have exactly the same title at the top of each column. So I didn't include this title because of course I would like to have some space to get everything in this slide. Okay, so what I'm going to do is to explain the structure of the social accounting matrix, and then I will illustrate a few rows and columns. And after this slide, I will present a social accounting matrix with data, but it will be related to the general equilibrium models that I have presented in the previous video, which is very simple. There is no government, no saving, no investment, no relations with the rest of the world, only one good, a single agent. So it means that there will be only a few cells filled with data. And this is because the economy which is described is very simple. But what I will do in the next videos is to introduce, in fact, 3 goods, then a government, and so on. And each time I will fill new cells with data. And you will have at the end of the process something which is more representative of what modelers are doing. Okay, so you remember that we have to understand the formations of income and then the distributions and redistributions of income through transfers. So it's very ambitious, and it is for one economy during 1 year. So what you have to keep in mind is the fact that in columns you have outlays, and in row you have revenues. So for example, if I take the case of direct taxes, this cell, you have to look at above this cell at the top of the column 3. This is enterprises. So it is enterprises that pay direct taxes to the agent which is in row, which is on the left. This is public administration. So in fact it's corporate taxes paid by enterprises to public administration. So you've got to keep in mind this principle to understand every cell. So I can give an illustration with households. So in fact, in row, you have all the revenues, and in column, you've got all the outlays of households. So it is column 2 and row 2. So for example, column 2 is relatively simple to understand because in fact you've got inter-household transfers, okay? So it means that this is money paid by some households to other households. So for example, in fact, money paid by urban households to rural households when they belong to the same family. After that, you've got a second cell which is filled, which is in fact payment of taxes by households to public administration. Then you've got households which consume, that is to say that buy goods and services. And then you've got saving of households in the row capital account. So you've got all the utilization of the income, which is the income of households. And so the formations of households, of income for households is given by row 2, which is first cell labor income, second cell, well, money received from other households, that is to say inter-household transfers. Then you've got profit distributed by enterprises to households. And then you've got transfers to households by the government. For example, a government which give social transfers to households. And then you've got net current transfer from the rest of the world. So for example, if some citizen of a country decide to migrate to a foreign country to have a job and to get money and send this money to their family in the country of origin, these are remittances, and you've got some money within this cell. And so you've got the total of this row, so the last cell of this row 2, which is equal to the total of the column 2, which is the total household current outlays. Okay, so you can in fact understand what is in each cell and the constructions of the social accounting matrix. I would like to give you other comments about important lines and important rows and columns. So for example, you've got row 5 and column 5. So it's in fact goods and services. So it's supply of goods and services and demands for goods and services. So in column you've got the supply. In fact, there are two sources of supply: the sales by domestic firms and imports. And these sources of supply are given in total with in gross term, that is to say you've also got the net taxes on products, that is to say the consumption taxes, for example the value-added tax, and the import duties. And in row 5 you've got in fact some cells which are filled. So first cell, this is consumption of household, so demands for goods and services by households, then consumption of government, then intermediate consumption, that is to say enterprises that buy goods to other enterprises in order to incorporate these goods within the production process. And then you've got the fixed capital formation, that is to say when enterprises buy capital goods. And then you've got demand from the rest of the world, that is to say exports. And so if you look at the total of this row, you've got the total demand of goods and services in this economy. And if you look at the total of the fifth column, you've got the total supply, and you must have total supply which is equal to total demand. Okay, I would like to comment the row 7 and the column 7. So you've got the capital account. So in row 7, you see that you've got saving of households, plus saving of enterprises, plus saving of governments. So it is the capacity to finance of this economy. And in column 7, you've got the investment by firms, that is to say the fixed capital formations. And you've got the foreign current account. So if this foreign current account is positive, it means that savings from households, enterprises, and government are enough to not only to finance fixed capital formations by firms, but also to accumulate some assets of the rest of the world, that is to say to finance the rest of the world. If this foreign current account is negative, it means that the rest of the world finances the economy, because in fact savings from households, of enterprises and of governments are not enough to finance fixed capital formation. So you've got here another social accounting matrix, and this time a few cells are filled with data. So it's the same presentation as the previous one, except that right now we have a differentiation between labor and capital in the row factors of production. And so it means that we have a new row, so we have 9 rows. And remember that you've got exactly the same titles for the columns from 1 to 9, and so you've got 9 columns. So this is in fact the social accounting matrix, which is related to the computable general equilibrium model that I have presented in the previous video. So an economy with one agent, a single good, no government, no savings, no investment, no relations with the rest of the world. So something very simple, and that's the reason why there is not many cells here filled with data. So in the next videos we will fill these cells with data corresponding to all these new assumptions that we will introduce in the computable general equilibrium model. We start with, for the explanations of the social accounting matrix, with the production of goods and services, and in fact the activities. So in fact there is an activity of producing goods and services which corresponds to productions of 10,000. So it means that we've got an activity that generates an income of 10,000. This allows, in fact, to give remuneration to productive factors, 3,000 to labor, and 7,000 to capital. In fact, labor is owned by households. So it means that households has an income coming from their ownership of the labor productive factor. And in fact, the remunerations of capital of 7,000 is given to enterprises. And in fact, the enterprises decide to distribute profits to households, because households have stocks on these enterprises. So it means that the total income of households is 10,000. And so it means that with this income, households can spend money in the consumption of goods and services for a total amount of 10,000. So you remark that the total of column 3, 10,000, is equal to the total of row 3, 10,000. And it's true for every row and column. For example, for the first row and the first column, So you've got the total remunerations of labor, the total is 3,000, and you've got the remuneration, the factor labor, which gives 3,000 to the owners of the factor labor households. And so the total is also 3,000, and you've got exactly the same thing for each pair of column and row.